All right, let's jump right into this explainer. We're unpacking the absolute brutal, high stakes economics of the mining industry. We're going to look at the massive, honestly terrifying chasm between the romanticized idea of finding gold and the highly complex, mathematically unforgiving reality of actually extracting it. Picture this for a second. You just inherited a gold mine. Maybe it's an old, shuttered pit in Ontario or a brand new discovery out in Western Australia. Now, with the price of gold sitting at a near-record $4,000 per ounce, owning a piece of land full of it has to mean you're instantly filthy rich, right? Well, the honest answer is maybe. Possibly. It really depends on a set of variables so incredibly complicated that some of the most experienced mining executives on the planet have gotten them catastrophically wrong. Section 1. The gold mine illusion. Reality versus fantasy. To figure out if you're actually rich, we've got to shatter this romanticized illusion of what mining looks like from the inside. Look, modern mining isn't about finding literal treasure chests. Gold down in the dirt isn't money yet. It's a raw material locked inside billions of tons of solid rock. And the concentration is so invisibly thin, you could dig with your bare hands for years and never see a single flake. You're blasting apart, hauling, crushing, and chemically processing anywhere from 30 to 300 tons of solid rock just to extract one single coin-sized 31-gram ounce of gold. You aren't on a treasure hunt. You are running a massive industrial rock-crushing factory. So this brings us to ore grade, arguably the holy grail number in this business. If your mine is sitting on just 1 gram per ton, you are surviving on razor-thin margins. At 3 grams, okay, you're doing reasonably well. Hit 8 grams, and you've got something extremely valuable. And then you get these wild anomalies like Australia's Fosterville mine. Back in 2015, they hit a zone averaging over 44 grams per ton. I mean, that is a literal billionaire maker. It drove their production costs below $400 an ounce. But keep in mind, most mines are stuck in that 1 or 2 gram territory, sweating over complex math every single day just to keep the lights on. Moving on to Section 2, a mountain of hidden costs. Basically, bleeding cash. Because long before you can sell a single ounce of that gold, you are going to hemorrhage money for years. First up is exploration drilling. You'll spend millions blindly drilling into hard rock. 100 holes could easily run you $30 to $60 million, averaging out to about $62 for every ounce you actually discover. And there are zero refunds if you come up empty. Then comes permitting. In the US, you're waiting 5 to 8 years for permits. That's up to 8 years of paying lawyers and consultants while generating exactly zero revenue. Finally, financing. You might take on $1 billion in debt, meaning you owe $50 million a year just in interest before a single shovel hits the dirt. Or you take a streaming deal, giving up the right to sell your future gold for a locked-in price of, say, $400 an ounce, completely missing out on that amazing $4,000 market price. And once you start building, oh man, the construction risk is wild. Just think about this staggering $5.1 billion figure. Barrick Gold, the biggest player in the game, tried to build the Pascua Lama project. Initial estimates were around $3 billion. But thanks to environmental violations, regulatory fines, and these massive cross-border tax disputes between Chile and Argentina, costs ballooned over $8 billion. The whole thing was suspended, and Barrick was forced to take a $5.1 billion write-down in a single quarter. Let's say you miraculously finish construction without going bankrupt. Your day-to-day ongoing costs are frankly terrifying. $450,000. That is what it costs to replace one set of 6 tires on just one of your ultra-class haul trucks. And because abrasive mine roads literally eat rubber, those tires only last a few months. Multiply that across a fleet of 60 trucks, and your tire budget alone is the size of a medium-sized company's entire revenue. And the spending just never stops. Your remote mine is effectively a small, incredibly expensive, isolated town. Your trucks are burning 30 gallons of diesel every single hour. Your massive steel grinding mills consume 40 to 50% of the plant's total electrical power. And because you're out in the middle of nowhere, you're footing the bill for fly-in, fly-out charter flights, housing, and cafeterias for your workforce. Speaking of which, U.S. mining wages spiked over 8% in 2025 alone. That adds tens of millions to your costs without adding a single extra ounce of gold production. Which brings us to Section 3, the all-in sustaining cost, the ultimate boss you have to defeat. To make sense of this relentless cash burn and figure out if a mine is actually viable, the industry introduced a metric called the all-in sustaining cost, or AISC. Rolled out in 2013, this is the true heartbeat of your operation. It's a single, unified metric that captures every single direct and indirect cost required to sustainably produce 1 ounce of gold. For some context here, in 2024, the average AISC was around $1,716 per ounce in the US and $1,513 in Canada. This one number dictates your survival. What's really brilliant about AISC is that you can't hide from it. It rolls up absolutely everything, so you can't artificially inflate your balance sheet. It covers the direct digging and crushing. It covers the sustaining capital to replace those crazy expensive truck tires. It covers corporate overhead. And, crucially, it includes a legally binding accounting provision for the eventual and usually astronomical cost of closing the mine and restoring the land. And guys, environmental closure is absolutely no joke. Take the giant mine up in Canada. The operator went bankrupt and completely failed to set aside adequate closure funds. The result? Canadian taxpayers had to foot a $4.38 billion bill. Why? Because the site has 237,000 tons of highly toxic arsenic dust stored underground that has to be kept permanently frozen indefinitely to protect local water supplies. That is exactly why today's AISC forces you to put up financial bonds right from the start. Section 4, the profit margin equation, making the math work. So with all those massive expenses captured in your AISC, how do we actually make money? Well, at today's massive $4,000 gold price, the margins are looking pretty sweet. An efficient mine with a low $1,200 AISC is generating a huge $2,800 profit on every single ounce. Even a struggling mine dealing with an $1,800 AISC is still clearing $2,000 in profit. When prices are this high, everyone looks like an absolute genius on paper. But here is the massive trap at the center of this entire industry. Your compounding expenses making up your AISC, they are almost entirely fixed. Meanwhile, your revenue is dictated by a global market number that you have literally zero control over. Your truck payments, your environmental bonds, your union wage contracts, they don't suddenly get cheaper just because the global commodity market is having a bad Tuesday. Let's see how fast that rigid AISC can totally wipe you out. Imagine your mine produces 300,000 ounces a year. In scenario A, with $4,000 gold and a $1,200 AISC, you are raking in $840 million in pure profit. But then scenario B hits. Gold falls to $2,000, which is totally normal historically. Inflation pushes your AISC up to $1,600, and the local government decides they want a bigger piece of the pie, jacking their royalty up from 2% to 8%. Just like that, your $840 million profit completely collapses down to $84 million. You are running a massive, highly complex industrial operation just to stand completely still. And hey, that profit equation assumes the gold is actually in the ground exactly where your models say it is. Back in 2015, Rubicon Minerals had an estimated 3 million ounce deposit. They spent hundreds of millions building out the infrastructure and a fully operational mill. But once they got underground, the geology was way more complex than the surface drilling suggested. The gold was trapped in narrow, disconnected little pockets. Almost overnight, 88% of their planned resource essentially vanished. They had to lay off 330 workers and file for creditor protection. The gold was real, the mine was built, but the company still got wiped off the map. Which leads us to Section 5, surviving volatile markets. Operating a mine doesn't just mean fighting the rocks beneath your feet. It means strapping into a financial roller coaster that literally never stops. You have to navigate incredibly wild historical swings. Gold was trading at just $250 an ounce in 1999. It peaked around 1900 in 2011, crossed 3,000 in March 2025, and skyrocketed to over 5,500 just this past January. Now it's sitting near 4,000, and JP Morgan thinks it could hit 6,000. Because your costs are rigidly fixed, a mine that prints money at today's peak could easily become a bankrupt, money-losing liability tomorrow if prices retrace. And honestly, even record-high prices won't save you if your AISC spirals out of control. Early in 2026, with gold sitting near all-time highs, industry giants like Newmont and Barrick saw a massive market shock. Newmont shares plummeted 26%, and Barrick dropped 19%. Why? It wasn't the price of gold. It was strictly because ballooning labor and equipment costs pushed their projected AISC all the way up to $1,680 an ounce. Even with high revenues, that creeping AISC absolutely terrified investors who know that thin margins are a disaster waiting to happen. There's a saying among experienced analysts that really hits the nail on the head here. The moment you build a gold mine, your primary business is no longer mining gold. It is managing the gap between two numbers that move independently. You aren't a gold miner anymore, you're a gap manager.
You're fighting a daily, exhausting war between wildly volatile global market prices on one side and your relentless, compounding fixed AISC on the other. At the end of the day, you can have billions of dollars of gold sitting in the ground, but if you can't dig it out for less money than the market is willing to pay you, it's really just shiny rock. So, after seeing the brutal reality of the all-in sustaining cost, the billion-dollar financing traps, and the massive environmental liabilities hiding just beneath the surface, I've got to ask you, do you still want that gold mine?